What other loan products do you think that buyers right now are underutilizing? We've got a new Fed chair nominee who takes office in May. How could this impact rates? How should buyers think about refinancing in the future when choosing a loan product today? Okay, Chicago, we are back. Episode 34. And look who I dragged back into the studio with me. Mr. Dan Gjeldum, the best lender in all of Chicago. Lender to the stars. Dan, thanks so much for coming back.
Thanks for having me. It's always a pleasure.
Always a pleasure. Okay, I'm going to jump in because we have a lot of things to catch up with. Spring market is here. We are in a whirlwind, and I personally am keeping my head above water, at least trying really hard to. So I wanted to bring you on. I wanted to talk a little shop, help our clients to understand, help our viewers, not just our clients, help our viewers to understand where the heck things are at and what can we do to try and navigate this wonderful market as well as we can.
Yeah, it's really kind of hit fast. I mean, it went from, we were freezing, right? Weather-wise, it was awful. Right. We were freezing and
I didn't want to go outside.
All of a sudden it started getting warm and then it's like, phone doesn't stop. Emails don't stop. It's crazier than I remember it being the last few years.
It's definitely started fast and furious and probably even a little more so than we thought. I think the inventory, as we've seen, right, that I word that I'm so tired of saying over the last 5.5 years, inventory is down again. Coming out of the gates, people are really, really anxious and really excited to try and make this the year for home ownership. It's creating a lot of challenges in certain markets. Not all of them, right? There's my little disclaimer. Not every market is feeling this, but some markets are feeling ultimately competitive. So let's jump right in. First and foremost, we are in 2026. We're not pontificating about it anymore. Have rates followed what you had originally expected so far?
They're lower than they started. But yeah, yes, rates are better. I think the market is they're not going to go up too much. They're not going to go down too much. So we're just kind of holding a nice little level here. And for the right down payment and the right borrower, it's under 6%. So that's a big deal. Right?
It's a big deal. So wait, before we even let's talk about this, because in the beginning of this year so far, there have been a lot of crazy moments in the world, right? The world is going bing, 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 bing. News everywhere, good news, bad news, and everything in between. Really, really bad news too. How has the market reacted to that?
In the economic world, the really bad news is kind of muted because nobody knows what's going to happen still. Nobody knows. Is inflation still there, right? What's going on with the employment report? A recent employment report was revised where there were like 800,000 less jobs created. Let me
break this down for you people. We are numb to the news.
Yeah, 100%.
The economy is numb to the news right now because we are so used to being pelleted from every direction.
Yeah, it's so different than it's ever been with the muting part.
Right.
Yeah.
It's sad to say that things like that don't have an impact, but once again, our skin has grown incredibly thick to the wild card of life that we're living. And we're seeing that for certain. But the keynote, right, the nice takeaway is that and I have seen this on my end, there are definitely people that are locking in mortgages under 6%.
Yep.
They're using the 5 word, people.
Yes, it's like the gas station, right? Like 5.99 is better than 6. And it makes people feel so good.
Okay, so this is a conversation you and I have drilled into the ground, but we're going to bring it up again because I think it's an important one. A lot of people are talking about waiting for the rates to drop. Now, we just mentioned that they have hit a 5, but there are still people that are waiting for lower, waiting for something that gives them more purchasing power. What would you say to those buyers right now?
They have to stop waiting. It's just not the amount of, this is 2026. Lower rates were supposed to be in 2024, right? And they weren't.
Wait, didn't we hit 8% in 2024?
Yeah, and they were supposed to be lower in 2025.
Yep.
The amount of people who've waited have cost themselves a tremendous amount of equity just because prices are different than they were a year ago. They were different than they were 2 years ago, right? So, yeah, people waiting they just need to get over it.
Well, I think the hardest part that I see on my end, and I get asked this question all the time. Oh, I read this article. I heard this. I think I should wait till I have a bigger down payment or the rates are lower. The problem is with the rate that appreciation is happening and prices are growing because we don't have enough homes. By the time they get to that point, 2 things are going to happen. Number one, they're buying the exact same house, even though they're in a better position because that house is more expensive now.
Yep.
And they're losing the equity, so to say. So that's a downside. That's a negative that they're dealing with. And on top of it, right, you and I both know there are a lot of people out there that are waiting for this, right? That is the worst advice that I feel like I could give a client right now, is to wait for the rates to go down. But all those people, when the rates do go down a little bit more, what are they going to do? They're going to jump on the bandwagon. And what's going to happen to prices?
They're going to pay more for that house.
They're going to pay more for that house.
Yeah.
Find a way to get on the ladder right now. Refinance if rates go down.
100%.
Own the house for less money. Do better by yourself. So you and I see eye to eye on that, and I can't tell you how.
I mean, all the clients that did that they took that advice and bought last year, they're all refinancing now.
Right.
Right. So there's handfuls of people who listened to that advice that are now taking advantage of it with lower rates.
Okay. So for some of our markets, they're insanely competitive for our buyers. That's the reality of it. How can we use financing terms to make the offer stronger, even if the price isn't the highest?
We've done this in the past, right? In the super competitive markets, is everybody has to be pre-approved. If you're not pre-approved, you better be paying.
We're not going to see properties if you're not pre-approved.
Right. You're not.
We're just starting with that.
Not even happening. But we're doing the full approvals, the full underwrites again, right? Where we get them in to do the pre-approval, but we do all the paperwork.
Okay.
Everything except.
Let's break this down, because this is going to be, in my opinion, a bigger thing this year than we've seen in the past. So essentially, before, you needed a property to do a full-blown application, right? To go all the way through to get the approval to go to there.
Yep.
Rewind. Now, you've had access to this product for at least 3 years, if not longer, right?
Yeah.
So you can do a full underwrite on a person.
Full-blown underwrite. That's
you can
good
get a
for 90 days.
Full-blown approval.
Don't need to do credit report again. Don't need to verify income. Well, you got to verify they have a job later, but we don't need to verify.
Details.
Collect statements. We can do all of that.
Okay, so now let's play this out. Let's put this in real time. If somebody is fully approved in your eyes, if they were going to then find a property and they were going to write an offer, what are the only things that would be remaining on your eyes to get that approval?
Single family home, the appraisal.
Okay.
If we need one, because we can do appraisal waivers. These days with at least 10% down.
Okay.
And condo approval.
Okay.
Right, if it's a condo. And then they have to get insurance. I mean, it's...
So the reason that this is important is because as it gets more competitive, there is an opportunity to write a cash offer subject to financing. What does that mean? That means we can write an offer that has the equivalent and can compete with cash offers or seems stronger than a financed offer, that we know all we have left to do is a condo approval and possibly an appraisal. Yep. Now, we're going to talk in a little bit later about appraisal waivers, so that's going to come back up. That may not even be something that we're keeping a contingency on anyways. So then we just come down to if it's a condo. So there is a way to possibly write stronger offers confidently, not too risky, and put yourself in front of the competition.
Because the piece of paper that goes along with your offer says loan commitment on it. It's subject to appraisal and condo and that stuff. It doesn't say pre-approval. It says loan commitment, which is what you have to deliver at the end of the process anyways. So it's a big deal.
And as I said, mark my words here right now, at the end of this year, we are going to see more people writing cash offers subject to financing than I think any year before.
Yep, I would agree.
Okay, so I'm going to transition because I mentioned the point of this appraisal and appraisal gap addendums. This got big last year. So for us, what we see is that when the offers get competitive, the prices get big, right? When the prices get big, the question mark always comes back to, well, if you're offering so much more above the list price, you should take some responsibility for it as the buyer. Hence the idea of an appraisal gap addendum or an appraisal waiver. What does that mean on my side? My side is different than your side. On my side, that means that essentially a buyer is taking responsibility in the appraisal in case there's a deficit. Now, they could do a full-blown waiver, meaning that no matter what the appraisal comes back at, they're going to find a way to navigate forward. Or they can do it, a lot of times I recommend to do it above the list price. Tell the seller they've got to have the skin in the game to the number that they picked. We'll take a responsibility above that. Now, before we go into what appraisal waivers are on your end, how would you, because I know I've brought you in on a lot of these conversations. Dan, fast forward, we do this, and then Hopefully we don't have an appraisal issue, but if we do have an appraisal issue, how do we navigate that?
Yeah, I mean, from a buyer's, when we explain it to buyers, right? Because they're always like, well, Amanda talked about the appraisal gap. What does that mean? And simply put, if you're doing, 10% down and the appraisal comes back in 5% less than what you're paying, now you're still in the game for the 10% down, but the loan is 95% instead of 90, right? If you're doing a larger down payment, like a 30 or 40% down payment, do you really care if it comes back in lower? No, because it's not going to have any material impact on your mortgage. As long as it doesn't, if it was a 5% down deal, that's where it gets, they have to really be understanding of the implications. But other than that, it's just a matter of, does it change the mortgage for that specific person? And if it doesn't, then they understand that risk as I explain it, just like you've explained it.
So on that point, this is a vast generalization of questions. How many appraisal issues have you seen?
Oh, you don't do that to me.
Come on, give me a ballpark. 10%? 5%? None?
No, it's like less than 5.
It's very little. Knock on everything. We're knocking on wood here, people. Right. The reality is that most appraisers kind of understand what's happening in the market, and they don't necessarily want to get in the way. Now, this will transition into the other idea of what an appraisal waiver is in your eyes.
Yeah.
Because with certain lenders, in certain locations, and certain down payments, there is a little bit of a lottery selection in which somebody could qualify for an appraisal waiver. Tell me about that.
Yeah. So it only applies to Fannie Mae and Freddie Mac loans. So your standard cookie cutter loans. Appraisal waivers will never go into, they'll never go in with a value over $1 million, right? I ran one today with a value of $999. It wasn't in Chicago. It was out in Portland. But $999 got an appraisal waiver. It's worth like 1.2, but we didn't need that. So I just said, let's save the money on the appraisal. It was a refi, $999, got it. But it's at least 10% down, no values over $1 million. And it's what we've found, right? And we have a system where we can estimate this before, like when you're in these situations, we can run the address through and what price you're paying and what their down payment is. And it'll tell us really accurately, like in the 90 percentile or higher
whether
range,
or not you'll
if we're going to get a waiver. Houses that have traded.
I'm gonna back us up 1 second. So essentially what this means is that an appraisal is not required for your bank to move forward on the loan.
It's not required at all.
Okay, just want to make sure that point was clear, is that a buyer would have an elective of whether or not they wanted to spend the hundreds of dollars on an appraisal, or if they didn't want to and they just wanted to move forward based off of what they knew.
And those waivers are built on data, right? So if the place is traded in the last 10 years, there's enough data on it. If it's a home that's been owned for 30, 40 years, and it's $500,000, it's not going to get a waiver because there's no data on it, right? Yep. So it's public information, but it's also the information that Fannie and Freddie have gathered with all the transactions in a certain market, right? Based on all the appraisals that have been done. And all of that data that they have in their systems, it spits out those waivers. And a lot of times, like I've had it where people pay over list by a lot of money and they still get a waiver.
A lot of money.
Which makes everybody's life easier.
Right.
Right? Where you're like, hey, you paid X amount over.
As a listing agent that is trying to go back and forth between a couple of top offers, I've gone to the lender and said, can you submit to tell me whether or not this will qualify? So that I can at least then go back to my sellers and say, well, this one can qualify for an appraisal waiver, but this one can't. Right. And all of a sudden, that eliminates one more obstacle between us and the closing line.
Yep, 100%.
So, I know we've talked a little bit about the power bid, aka the getting the full commitment.
Yep.
What other loan products do you think that buyers right now are underutilizing that could really help them?
ARMs. 100%. I know we were going to talk about this. Right?
We can jump ahead.
Skipping ahead. ARMs are being underutilized.
Yeah.
If you have 20% down, 25% down, and I say this only because like ARMs really have a difference. I sold a 5.5% 7-year ARM today. 5.5%. That's
7
way
years
in.
Makes me feel risky.
I know, but it's way in the fives.
Not that kind of show, Dan.
It's way in the fives, right? And if you're talking 5.99 on a 30-year, that's a big difference for people, especially if you're not going to be in the home for 7 years. If it's your first purchase and you're going to move and you're going to sell that property, There's no risk to an ARM.
Yeah.
The rate is fixed for 7 years. A 5-year ARM, it's 5. A 10 is 10, right? There's zero risk in it. It's the same. It's amortized over 30 years. It's paid just like a 30-year fixed is. It just has a lower rate. And the good part about the lower rates is for those people, lower interest rates means you build equity faster too. Right. So on a, and it's not going to be a massive amount of equity, but you're still building equity faster on the ARM. So that's not being utilized enough.
No, I think you're right. Right. And I think after the housing crisis, I think people got very afraid of ARMs. The reality is during the housing crisis, I had an ARM product and I rode it for a few years.
We all did.
Right. But I think that coming off of that, there was a stigma.
Yep.
And I think especially when the 30-year loan products were so low and so stable, there was no sense in them. You did not have any need to look at them. But I think you're very correct now. Now, I'm very risk adverse, right? So for me, shorter term ARMs, they make me nervous. Even if you only plan to be
5 years goes like that.
5 years goes like that, right? 3 years, 5 years, anything like that. For me, I professionally don't recommend anything under a 7 or a 10.
Yep.
For me, that gives us the chance for life to go sideways a couple times, for us to kind of, get life screwed up and put our lives back together and then navigate the next step. Now, the other thing is about ARM products, and this is the other piece that's really important. As we are in a market where people are talking about, are rates going to get lower at some point? 2 years from now, those rates get lower. Well, you refinance the ARM product. Yeah. Maybe put it into a 30-year then, or maybe put it into another ARM product. Right. Like that's part of it, is that thinking if you do a 7-year ARM, that doesn't necessarily mean that you need to move in 7 years. That just means you're either going to move or you're going to refinance before that time comes to expire.
Yep.
So absolutely. I agree with you 100%. I think the ARMs have gotten neglected more from a fear base than anything else.
Yeah. And I think it's also the buyers, the generations, right? Because there's a lot of kids buying whose parents had bad experiences with it. Because how many people have we talked to before that are being guided by their parents, which there's nothing wrong with it.
We love parent involvement, especially when they're helping to foot the bill.
Exactly. But parents are, throwing out that only get a fixed, right? Because they don't understand.
They lived in a generation where they worked the same job, they stayed married to the same person, and they lived in the same house all for 30 years.
Yep.
Now we all love change, except for me, dear. I do not love change in marriage.
Neither do I, for the record.
Right? For
this
the
is
record.
On video.
For the record.
Me neither.
Okay, so I think we're kind of transitioning into this next question, which is, I think, an important one to hit into. How should buyers think about refinancing in the future when choosing a loan product today?
Yeah, so first of all, rates don't have to drop a point to refinance. Doesn't need to happen. If rates drop a quarter point, depending on your situation or your loan amount, could make a lot of sense. And the costs involved, right? All those people that were waiting to buy were hoping for lower rates, right? And all those people that didn't wait and they bought are taking advantage of the lower rates now. So rates don't have to get lower. They also don't have to go higher. There's no rules in the interest rate world. When people are thinking about, when I refi in the future, it's also what you're going to use that money for, right? There's people who they didn't think they'd need to refi, and all of a sudden they lost a job, their credit cards went up, so they're going to use that, right? There's reasons to refi, and I think that when people think about products that they choose, the ARM, for example, take advantage of the lower rate now, refi into a fixed later. A lot of people have been refinancing into 15-year fixed, into 20-year fixed, right? That shorten their terms. So there's tons of reasons to refi other than just saving on your monthly payment.
For certain.
And I think that people need to, when they think about those options in the future, right? They if they have questions, they can always ask, what should we be thinking about?
Sure.
When? But refinancing is something that you can always do.
For a multitude of different outcomes.
Tons of different outcomes.
I think that's an important.
It's always an option in the future. Refis aren't going to go away.
Right.
Right? Yeah.
Absolutely. 100%. I think that's a great takeaway, is just, I think that sometimes our relationships with the idea of refinancing are very stagnant. And so that we have to be a little bit more open-minded, that even somebody that maybe lost a job or had something happen, maybe there's a different type of way to contextualize that conversation.
And for those of us that lived through the financial crisis in this job, remember when prices dropped, the government stepped in and said, people still need to be able to take advantage of these lower rates. So we're going to help out. And they created new guidelines, right? So there's
We can hope for the government.
Yes, there is some hope.
I don't know how much we're going to hope right now, but we can hope for it. Okay, we've got a new Fed chair nominee who takes office in May. How could this impact rates?
Rates could go up, rates could go down.
Right.
But one thing that people
Hold on, I'm going to grab my crystal ball out, guys.
Yeah, for sure. Just because it's the person in the seat, there's a board. There's a Federal Reserve board that makes the decisions, right? There could be someone in that's all about lowering rates, lowering rates, lowering rates. But if the rest of the board doesn't, a majority of the board doesn't agree with that person, it's not going to happen.
Wait, are we talking about the Fed or the presidency now?
Right. Yeah. The Fed. We're talking about the Fed.
Point McMillan.
Yes. It's the person in charge of the Fed, like the Fed chair, is going to be viewed by the market in a certain way, right? They're either going to be viewed as someone who wants to cut rates or someone that follows the market and follows the data, right? Because that's what Jerome Powell always did. That's what Greenspan did. Everybody, Janet Yellen, everybody who had that position before, they did that stuff. If it's someone who's just simply going to listen to the person that sits in the Resolute desk on what to do, it's not going to be received well. The market is the market. Like if they don't like it, they'll sell bonds, which makes rates go up.
Right.
Right. So the Fed chair is going to kind of set the tone, if you will, on terms of what, they view the market as. But data is data. And if you cut rates to simply cut rates, the market will throw a temper tantrum and it'll sell off, and rates will go the other way, and rates always go up faster than they go down.
There's a key point. Let's hold on to that for a minute. They always go up faster than they go down. If you heard it here, you need to hear it again. That's an important note to have for certain.
Yeah.
Especially as we navigate wild times in our world, regardless if we're not numb to it, is that some of this stuff is really consistent. I hope, right? I'm going to probably get a lot of backlash for this comment right here. I hope that our rates stay fairly even keel, because the reality is if they go down too much, our market is going to get into a tougher, more difficult position because we will have more consumers, more demand, and still not enough inventory.
Yeah, and you'll have more people waiting again for them to get better.
On that note, Dan, you are always a wealth of information. We are so blessed and honored to have you here. Thank you for helping to educate the viewers that tune in. Thank you for personally and professionally helping myself and my clients navigate these interesting times.
Always a pleasure. Thank you.
Until next time, Chicago.